Topic 6, the income of minors and the taxation of trusts. This is another topic which is split into two. In the first part, we're going to look at Division 6AA, which is the taxation of minors. And by minors, I mean people under 18. If you understand the concept behind this division, it's actually a really easy division to apply. But it does involve you trying to understand it and not just memorise certain little bits of it. If you think about it, if a taxpayer had a lot of income and wanted to avoid paying tax at the top marginal tax rate, one of the ways of doing it would be to put income earning assets into the names of children. So if you had a taxpayer with 4 children and you had money in the bank, or you had dividend producing shares that were producing a lot of dividends, or perhaps you had large, maybe you had a business, you could introduce your children into the business. And if they were under 18, obviously you as the parent would be controlling what they do and all their money. So it would be really easy to have the 4 children receiving this income. Therefore, if you would get 4 children getting the $6,000 tax-free threshold, the 4 children being taxed on income at 15%, whereas you as the parent might already by this stage be up on the 45% tax bracket. So this was a way of, by putting income into the names of minors, your children under 18, it was possible to minimise the amount of tax a taxpayer had to pay. So what the government did was it introduced Division 6AA. And what it says is this. Firstly, it applies to every child under 18. Then it starts off and says, look, there's certain children who should not be impacted by this division. So what we're doing, we'll get rid of those children out of this division. And those are called accepted children. They're accepted from the division. Then, of the children who are left, they are called prescribed persons. And then, some of their income is accepted income. So some of their income is accepted from this division. It will be taxed at normal rates of tax. And everything that's left is taxed basically at 45%. There's a small threshold, there's a phasing in amount, but once you hit above that phasing in amount, every dollar is taxed at 45%. So the reason for this section, for this division rather, is to ensure that living people do not put income earning assets into the names of their children or associated children, you know, nieces, nephews and so on, in order to benefit from the tax-free threshold and the lower tax rates. So that is the concept, that living people do not divest themselves of income earning assets and put them into the names of children. However, certain children will pay tax at normal rates, and we'll look at who they are. And of the remaining children, certain income will be taxed at normal rates because of the idea behind it, so that living people don't put income earning assets into the names of children. If you understand that concept, it's actually a really easy section to apply, or division to apply. But many students don't take the time to understand the concept. If you're going to put $100,000 into the bank in your child's name, and it's going to be taxed, the interest is going to be taxed at 45%. You may as well keep it in your own name and have it taxed at 45%. Because you could have a problem, the child then gets to 18, can operate the bank account himself or herself and takes all your hard-earned money and goes off and spends it. So what they've done is they've said, we're going to put you in the same position. If you put it in your children's name, we'll tax it at 45%. You may as well leave it in your own name and pay tax at 45%. With the top marginal tax rate now cutting in at $180,000, the original estimates were that only 2% of the population would pay tax at 45%. So what's now happening is you're probably better leaving it in your own name, because it may well be that you're going to pay tax at 40 or even 30%. So let's start with Section 102AC1, and we're in the 1936 Act here. So who does this division apply to? It says a person is a prescribed person if the person is less than 18 on the last day of the year of income and is not an accepted person. So let's look at the main things. A prescribed person is under 18, not an accepted person. So what we need to do is we need to look at who is an accepted person. And these are the definitions in 102AC2. A child who is in full-time employment. Now, you could have a 15-year-old. So actually, one thing before we go that far. In Australia, children generally have to be at school until they turn 15. Now, in Western Australia, they actually have to stay at school till they're 17 unless they're in some sort of education. But basically, if the child is under 15, you know that they're in full-time education. Above 15, I will actually say the child is a student or the child is fully employed or something like that. But if the child is under 15, you will assume that the child is in full-time education because they cannot be employed full-time until that point. So the first exception is that the child is in full-time employment at the end of the year. Now, it could, of course, be that the child was studying until December and then finished school having turned 15 and then takes up a full-time job after that point. And at 30th of June, the child is in full-time employment. Then the child is an accepted person, accepted out of the legislation. So what they're saying is, here's the legislation, here's Division 6AA, your child is accepted from that. So your child is sitting over here, and all the normal rules we've looked at will apply to that child. The second one is that the child is disabled, but getting certain pensions or meeting certain pension requirements. This one and the next one, the double orphan, also meeting certain pension requirements, actually makes sense if you think about it. To get those particular pensions, the child is usually fairly severely disabled. And often what might happen is the parents or the grandparents may well put income earning assets into that child's name so that the child has got a source of income for many years, because obviously the child is not going to be in a position to work in the future. With the double orphans, that means both parents have died. It may well be that say the parents have died, the grandparents may well want to set up a source of income for those children because, of course, they don't have parents to support them. And the grandparents may worry that if they die soon, how will those children be supported? So rather than rely on the charity of the rest of the family, they may well set up something for those children to earn income, and that income will support the children until they can earn their own income. So in each of those instances, those children are called accepted persons, and any income they earn will be taxed at normal rates of tax. Now, we then come in 102AE to the income of prescribed persons. So these are children who are under 18 and are not in full-time employment, or disabled getting pensions, or double orphans getting pensions, and so on. Now, they will be assessed on their eligible assessable income. The definition of eligible assessable income: eligible to be taxed under Division 6AA. Eligible assessable income will be taxed under Division 6AA. Accepted income will be taxed at normal rates. So again, what is accepted assessable income? Before we look at this, think about, what do we mean? What is the division trying to tax or trying to prevent? It's trying to prevent living people, mums and dads, aunts and uncles, grandparents, putting income-earning assets into the names of children to benefit from the tax-free threshold and the lower tax rates. That's the intention of the division, to prevent that happening. So what income can a child under 18 earn and not be taxed under Division 6AA? And really what we're saying is, this is income which is rightly the income of the child. The child's earned it, or something happened that the child received this income, and it should be taxed at normal rates. Section 102AE2, accepted income. This includes things like employment or business income. So a child who has a job after school or on the weekends, that income is accepted because the child has actually done some work in order to earn that money. The child may have a small business, perhaps walking pets or doing a bit of gardening for people in the neighbourhood, and that income is, the child receives the income from doing some work. So that income is accepted because it's not a living person divesting themselves of assets to put into the child's name. So keep coming back to that concept. Investment income from the investment of damages. Now, if you think about it, perhaps a child who has a part-time job is injured at work and receives a lump sum payment, or a child is injured in a car accident and receives a damages payment. If that payment is invested, that income is accepted income. Again, it's not the mother, father, uncle or whoever putting income-earning assets in the child's name. The child was injured, received a payment and invested that payment. So that is accepted income. Similarly, the investment income from anything left to a child from a deceased estate, or paid by a superannuation or provident fund to the child. So, for example, one parent may die, not two, because if it was two parents, then your double orphan provisions with pensions might apply. So say one parent dies and leaves the child $100,000 or $500,000, and that money is invested and there's some interest arising each year. That income is accepted income because the parent or whoever it was died and left the child the money. That money was then invested. Interest from salary or from any of those other sort of things. Let's say a child receives a salary, banks a lot of that salary and starts to receive interest income. That interest income, because it came from accepted income, is also accepted income. So what we're saying here is either the child worked or the child was injured or something like that, and as a result the child received those that money, and that money was invested, or it was salary and wage income or business income. So all that is accepted and it's taxed at normal rates of tax, so tax-free threshold and so on. Okay? And what you're left with is income taxed at the top marginal tax rate. So let's look at our example. We have Bronte, who's 16, earns a salary from a part-time job, and then in addition she's got some interest because her father puts some money in a bank account. So when you look at a child under 18, start thinking your way through a series of steps. First thing you say is the child under 18? Because if the child is 18, then the division doesn't apply, because at 18 the child becomes an adult. So first question, is Bronte under 18 at the 30th of June? And the answer is yes, because she's 16. The second question, is she an accepted person? Is she in full-time employment? Is she a double orphan getting a pension? Is she disabled getting a pension? And remember, our questions will have to tell you that. And the answer here is no. So then we say she is a prescribed person. Now, let's look at her income. Is any income accepted income? And yes, some of the income is accepted because it's her salary. The interest is eligible. So what we now have is we have her receiving a salary. The salary is accepted assessable income because it came from her efforts, and so that's accepted and taxed at normal rates. And the interest is eligible because her father put it into the bank for her. Now, it doesn't matter that the father might have been motivated by the best of intentions, like, if you do really well in your exams, I'll put $10,000 in your bank account. So while the father's not actually trying to divest himself of assets, the fact is, if you go through the steps, it doesn't fall into any of the accepted categories, and so it has to be taxed at the top marginal tax rate. So here we've got a taxable income of $12,000, but the income that makes it up is taxed in separate ways. So we tax the salary. So if you look at the line, the salary is taxed at ordinary rates and the tax is only $600, but the interest is taxed at 45% and the tax is $900. Now, you would then, so you'd say, what is your taxable income? You need to set it out this way because you can then see what your taxable income is, and that, of course, is the figure that attracts the low income rebate. So even though the taxable income is only $12,000, there is still tax to pay because the interest was taxed at $900. Now, just while we're at this point, I, as you know, have been marking some exam papers, and in one of the questions it said something like the child had interest of whatever the amount was, which came from $90,000, I think it was, that the parents had deposited in the child's bank account. And a large minority of students, so it wasn't just one student, quite a few students, also included the $90,000 as income. And you know, right back from topic 1, that can't possibly be income. It's not regular, recurring, it's not in return for services provided, it's not from a business. All those things we looked at in topic 1. And so that's what I hope you get out of this course, is the ability to think your way through these issues. And we have actually done that in another question, so it shouldn't have been something new. And I appreciate that in the exam you're under a bit of pressure. But do bear it in mind, it's always the interest that's assessable, not the original payment. Now we have an example with Natasha, who's got the Fitzgerald, she's 17, Fitzgerald Family Trust, a deceased estate, interest investment by the grandmother and the salary from a Saturday job, what is taxable income and net tax payable. Again, this is something you should stop and try and do on your own. Remember, because she's under 18, you keep going through those questions. Is she under 18? Yes. She's therefore prescribed. Is the income accepted? So you look at each of those amounts of income that she gets. The family trust, the deceased estate, so you know that that's coming from someone who's died. Interest investment invested by the grandmother. So you haven't been told the grandmother's dead. And the salary from the Saturday job. For each of those, you say, is it accepted income? And what you'll find is that the family trust and the interest is eligible assessable income. It doesn't fall into any of our accepted categories. And then the deceased estate and the salary is accepted income. And remember, if it's accepted income, it's that total figure to which we then apply the tax-free threshold, and then we tax it. So that tax is $750. The eligible income, the tax is $7,200. Now, I was sort of running out of room here, and so in fact, it would have been better if I could have done the income with the totals and then done a taxable income. But unfortunately on the slide, I really didn't have enough room. So you'll see that it's a good idea to always do the taxable income, because that will help you pick up your low income rebate. So we've got the two different types of tax, and we've got the total tax of $7,950, and less the credit under section 100 subsection 2, which you don't know about yet, but we will do shortly. So that at the end of the day, there's tax to pay of $3,150. I have ignored the low income tax offset in this example just because I was running out of room. That completes our study on Division 6AA. It's not a difficult division to apply if you understand the basic concept. One of the biggest pieces of advice I can give you is to keep your setting out really neat, because one of the things that happens is students sort of merge everything together, and then you can't see what is eligible income and what is accepted income, and you need to keep them separated from each other, but then you still want your taxable income to come through. In one of the papers I've just marked, exactly this happened, but because the students sort of didn't put everything together, there were low income rebates done in the wrong spots. The two different items of accepted income were taxed separately instead of coming together and being taxed in one hit. So please follow my setting out. You'll find it will make your life much, much easier. We'll now move on to the taxing of trusts. And the first thing we need to do is we need to look at what is a trust. And a trust is an equitable obligation binding a person who's called a trustee to deal with property over which he has control, which is called the trust property, and is held for the benefit of persons who are called the beneficiaries, of whom he may himself be one, and any one of whom may enforce the obligation. It's like a legal obligation that you have. Again, you've done trusts in your earlier legal studies. A trust has three requirements: the trustee, the beneficiary, and the property of the trust, which is called the corpus. Now, we are going to look at specific trusts, which are express trusts. That is, something has to happen to create this trust. And we're going to look at two types of express trusts. We're going to look at a deceased estate. So someone dies and the deceased estate is created with the death. And the second one is the transfer of property called an inter vivos trust, and that is because it's transferred from a living person. So inter, between, vivos, living. Now, why do we have trusts? We have trusts because there are some fabulous benefits in them. One of those trusts that we looked at, whether they be a deceased estate or an inter vivos trust, a trust can be a fixed trust. That is, the trustee, the person who controls the trust, has no discretion as to who gets income and how much income. So that could be the deed says to each of my 4 children and 25% each. So at the end of the year, the trustee collects all the income of the trust and then says, okay, 4 beneficiaries, $100,000, $25,000 to each child. It's the other aspect of a trust which makes it so good for tax purposes. And that is, a trust can be a discretionary trust. So the trustee can decide who gets income and how much income. Now, if you think about when we looked at a partnership, at the beginning you established your partnership and you said it was a 50-50 partnership or it was 30-70 or whatever. And there's very little room to move from there. If you pay salaries, they need to be commensurate with work done and so on. But with a trust, if it's a discretionary trust, the trustee will decide who gets income and how much income. So when you set up your trust deed, you would cast your net widely in terms of who are your beneficiaries. So if it was my trust, it would be set up for the benefit of Colleen Mortimer, her spouse. You don't name your spouse in case you have a new one. Or if you don't have a spouse at the time, so could be your current spouse or a future spouse, your children or future children. So for me, we'll go back to me, my parents, my siblings, their spouses, their children. And so you cast this net really widely so that you can decide, the trustee can decide each year who will get that money and how much money they're going to get. And that is the benefit of a trust. Now, let me give you a really good example that I came across many years ago. I had a client who came to me, and he was a young man who was not married, and he had a business that was making a lot of money. And at that time, he wasn't married, he had no children, and his actual setup was very expensive. The trustee was a company, then he had the trust, and all we could do was add up all the income, take off all the expenses, and distribute what was left to him. And it was sizable income. But as soon as he got married, we were able to distribute half the income to him and half to his wife. We didn't need to go back and reorganise ownership of the business, set up a partnership or anything like that, because his partnership deed said his spouse. And now that he had a spouse, we were able to distribute half the income to her. As you'll see shortly, when they started to have children, we were able to give, in those days, it was only the 416 that we covered in Division 6AA. Now, of course, it's a lot more because of the low income tax offset. We can give a lot more income. However, as soon as he had children, we were able to distribute small amounts of income to those children and assure that that at least was non-taxable. So it's fantastic because as soon as he was married, we were able to split the income. One of the areas in which this works really well is if you have a husband and wife, there is a business being operated through the trust, but say the wife is working outside the business. Now, a partnership doesn't work because you've either got to set it up that the husband's getting 70 and she's getting 30 to add to her other income. But if you ran the business in a trust, she could sit outside earning her income, her salary, and then and this is classically what happens, the wife stops work when she has children. So now she doesn't have a salary. Now the trust income can be split between the husband and wife. If it was a partnership and you already had your 70-30 split, that's all you can do. If you had a company and the husband had 70% of the shares and she had 30%, you've then got to go about issuing more shares, and there are various other complications that can arise from that. But with the trust, you can just give her half. It also works really well if, for example, you are helping adult children who may be going on to study. Rather than supporting them from your after-tax income, you can distribute income to those children and they'll pay tax, but once they're over 18, you're going to pick up the benefit of your $6,000, 15% and so on. When the child starts working, if you could just decide not to make them any more distributions from the trust. So it's this discretionary ability in a trust that makes them really useful for tax purposes. The other benefit of a trust is that it retains the character of the income that passes through it. So if the trust has a capital gain, you can actually say, well, I'll give the capital gain to this beneficiary who has a capital loss, or even a revenue loss. Okay? You can give overseas income to an overseas beneficiary in a lower tax jurisdiction than Australia. So you can decide which beneficiaries get which type of income. In a company, it doesn't matter whether it's business income, dividends, business income, interest, whatever. It all goes in and it can only come out as a dividend. But with a trust, a capital gain can be passed out as a capital gain. Overseas income as overseas income. So those are the two benefits of a trust: the discretionary ability and the fact that it retains the character of the income that passes through it. Trusts are operated according to their trust deed, and it's the trust deed that sets out who are the beneficiaries and whether or not the trustee has discretion. Now, before we go any further, there are a couple of terms we need to look at and really understand. The first one is easy, and it's legal disability. And what it means is that the law says this person cannot have their share of the trust income until they turn, because they're under 18. It could also be because they're an undischarged bankrupt or insane, but we are only going to look at children under 18. And this is where it ties in with our Division 6AA. The next term is this term present entitlement. And it's probably the term that gives students the most concern. To be presently entitled, the child must have an absolute right to the income. There is nothing, not even death, that will stop that child getting his or her share of the income. And that's what present entitlement means. Can this person go to the trustee and say, you have to give me that money? Because in the trust deed it says, that's my money. Now the trustee might say, well, you're under 18, so I can't give it to you, but it may be that that's the only thing. And it can actually be for more than 18, but we'll talk about that in a minute. So presently entitled means absolutely entitled to the income of the trust. Now, why is that so important? Let's look at this trust diagram. Remember, we're going to give you this trust diagram in the exam. I keep saying to my students, you will have this in the exam. So photocopy it out of your book, and every time you do a trust question, use this diagram. And you will not believe the combinations that I get in the exam. Now you know you're going to have it. Start using it. If you use this, you cannot go wrong. The reason present entitlement is so important is that it says the first question you ask is the beneficiary presently entitled? And if the answer is yes, then we go off in this direction and we follow what happens under there. But if there is no beneficiary presently entitled, we go off the other way and different things happen. So what is present entitlement? Now, if the trust deed says 25% to be held for each of my children, that's pretty easy. They're presently entitled. But if it doesn't say that, if it says something else, then we have to decide, is the child absolutely entitled? Now, let's say it's my deceased estate. And I say, and let's say my children range in age from 15 to 3. Now, different things could possibly happen because of that wide range in age. Obviously, the children who are 15 are very close, 14, 15, say, very close to turning 18. But there's a long way to go for the child who's 3. Now, while I want to treat my children equally, so each is to get 25%, I have to bear in mind what would happen if one of those children didn't reach 18. So what happens is the trustee collects the income, say it's 100,000, and the trustee allocates 25,000 to each child. And maybe the trust deed says something like the trustee can pay schooling or maintenance out of the child's share of the income. Now, the 3-year-old is not yet in school. The 15-year-old is, okay, and the other ones are as well. What we have to bear in mind is what would happen to that income that's been put aside. Maybe expenses are taken out, tax paid, but whatever's left is being allocated for those children. What would happen if one of those children died before turning 18? Now, for the child who's 15, let's say that that child has had a child. So I'm a grandmother. Now, what I would want to do is ensure that any money put aside for the eldest child, in the event that that child died, I would want whatever money had been accumulated to go to the grandchild. So my trust deed would say the income is to be allocated 25% to each child. Expenses are to be taken out as need be for schooling and maintenance. Any amount remaining is to be accumulated until the child turns 18. But I need to put in something that says, what if the child dies before turning 18? And because I've just got this one child who has a child, I would say, in the event that child number 1 dies before turning 18, the accumulated income is to go to her estate. And then, obviously, she would have a will. So let's say if she died, whatever money had been accumulated for her goes to the trustee of her estate. So nothing stops her getting that money. Even if she dies, the accumulated money goes to her estate. Therefore, she is presently entitled to that 25,000. So even if the trustee only spent 20 on her school fees and maintenance, and the other 5 is being accumulated for her, and that's happening, and then she dies, whatever money's there goes to her deceased estate. Therefore, she is presently entitled. Of the other children, I think, well, if they die before 18, there's no one else for them to give their money to. So I say, in the event the other 3 children die before turning 18, the accumulated money is to be split equally among the remaining beneficiaries. Now, they are not presently entitled. They will be presently entitled to anything the trustee actually spends on them. So, say for the second child, that if the trustee spent $15,000 on school fees and maintenance, they're presently entitled to the 15. They are not presently entitled to the remaining 10. And similarly for each of the other 2 children. So, presently entitled means you have a total right to the income. No one can contest your share, and if you die, it goes to your estate. Bear in mind that, and obviously if it simply says 25% to each child, they're presently entitled. If there's none of this to be accumulated until they turn 18, you can of course accumulate it until they turn 21, 25, 40, whatever. And you will often see that in trust deeds where perhaps a child is maybe in an say with adult children, if you wanted to accumulate some income, you may want to pay some expenses, but maybe they were in an unsatisfactory relationship, or perhaps they were, maybe they had a drug problem or something like that. You wouldn't want to give them a large amount of money. You may want to pay some of their expenses. So you could say anything extra is accumulated until they turn 40. You hope by 40 they're sane and sensible. If not, you can always change your trust deed until they're 50 and so on. So usually we use sort of 1821 because we're trying to keep it fairly simple here. But just to understand the concept, to be presently entitled, you have an absolute right to the income. In the event, if you look at section 101, it says you are deemed to be presently entitled when the trustee actually distributes income to you. So if my and this is what you have in an inter vivos trust. If the deed says full discretion to the trustee, if the trustee says, oh, okay, well, look, I'll buy that child a car, or I'll pay this child's school fees, or whatever, the amount actually spent on the child is presently entitled. Or that particular beneficiary. It doesn't have to be a child, because it could be that the trustee says, okay, I'll pay for the 21-year-old to go back to uni, and I'll pay all education expenses. As they are paid, that 21-year-old becomes presently entitled. So section 95, the net income of the trust. Again, it's net income because the trust doesn't pay tax. It's each of the beneficiaries, or on any remaining income, the trustee who's going to pay the tax. The trust doesn't pay tax. Now, let's look at this definition because, again, this does cause problems. The net income is defined as being total assessable income less all allowable deductions, except, there's always an except in tax, except in respect of a beneficiary who has no beneficial interest in the corpus, the trust property, or in respect of a life tenant, the deductions allowable under section 36 carry forward losses, but only if those losses are met out of corpus, are required to be met out of corpus. Again, it's an easy concept to understand if you think about what it means. What it's saying is this: if the losses of the trust are met out of the property of the trust, then only the beneficiaries who have an interest in that property can benefit from the carry forward loss. If the beneficiary has no right to the corpus and the loss is met out of corpus, they don't get the benefit of the loss. Now, if you think about what does that mean, why do they have that? Think about it as a family trust, and it says, here's all this property that's earning the income of the trust. Now, of the beneficiaries of that trust, we anticipate that it's going to be the children who are going to get the final property. So maybe the trust is set up for me, for my benefit and so on, but at the end of the day, I'm just going to get the income from the trust, and then after I die, it's going to be that the trust property is split equally among my children. So while I'm entitled to the income, I'm not entitled to the property of the trust. Now, if that trust runs into a loss, and the trust deed says any losses are met from corpus. So let's say we've got a building from which we earn rent, and we need to do some significant repairs to that building. As a result, we are in a loss position. And what we have to do to meet that loss is we have to sell some of our trust assets to fund that loss. Now, while my income might be lower because we've lost some assets, the children who have the interest in the property are the ones who now have less assets. So they are the only ones who will benefit from the loss. I can't benefit from the loss. If, on the other hand, the trust deed said, well, you can borrow to fund those losses, then I can also benefit from the carry forward loss. So if you think about it, what we're saying is the children, in the first instance, who had the interest in the corpus, the property, are the ones who now have smaller property, because we sold some of the property to fund the repairs which led to the loss. So they can benefit from the carry forward loss, I can't. And that's what that section is saying. But if we don't have to fund the loss out of the corpus, then we can all benefit from the carry forward loss. So here I have an example. We have two beneficiaries, both get 50% of the income, but only A gets the corpus on the death of B. In year 1, we have a loss of 1,000. In year 2, we have a profit of 8,000. So what is the net income of the trust? We're actually going to have two net incomes. One that we use to calculate A's share and one to calculate B's share. So the net income for A is 8,000 minus the carry forward loss to give us 7, because A gets 50%. Half of 7 is 3,500. And B, the net income is 8,000. B cannot benefit from the carry forward loss, so the net income is 8 and B's share is 4,000. So different net incomes depending on our beneficiaries. Section 96 says the trustee is generally not taxable, except as provided in the Act, and you'll see that as we come to a few sections. Now we're going to actually tax the net income of the trust. Get out your flowchart and we're going to follow this through. Have a look at section 97, which says if the beneficiary is presently entitled and not under a legal disability, that is, the beneficiary is 18 or more, then it is the beneficiary who is assessed. So if we look at our flowchart, the first question we ask ourselves, is the beneficiary presently entitled? Yes. Then you look at the thing, you follow that section. Then is the beneficiary under a legal disability? No. And therefore it is the beneficiary who is assessed under section 97 at ordinary rates. So just follow this through in your flowchart. So what that means is this beneficiary is over 18 or more. The beneficiary includes the trust income along with all their other income and pays tax on whatever is their marginal rate of tax. So just follow through, and we're now going to look at the example on Dr. Smith. And Dr. Smith is entitled to 1/6 of the Robinson Family Trust income. He's 55 years old. So, and the net income of the trust is 39,000, and Dr. Smith has other income of 40,000. So ask the questions. Just as we went through a list of questions in Division 6AA, we're going to ask ourselves the same questions here. Is Dr. Smith presently entitled? Yes. The trust deed says he gets 1/6. So no ifs, no buts, that's what he gets. Is he under a legal disability? No, because he's over 18. Therefore, he is assessed under Section 97 at ordinary rate. So what is 1/6 of 39,000? It's 6,500. So what is Dr. Smith's taxable income? It's other income plus the trust distribution, 46,000, and work out the tax payable on 46,000. And that's how much tax he pays. Very simple and the best way of doing things. We've mentioned Section 101 for discretionary trusts. It didn't apply here because Dr. Smith, the trust deed said he got 1/6. If it didn't, but the trustee applied that amount for him, he would be deemed to be presently entitled under Section 101. So in this example here, if the trustee buys a new car for A, which costs 10,000, A is deemed to be presently entitled under Section 101 to the $10,000. Now, we've done the really simple bit about being presently entitled and the beneficiary not being under a legal disability. But what happens when the beneficiary is under a legal disability? Think about it. The legal disability is the child is under 18. So the child could be newly born up to 17. So instead of the Commissioner taxing the child, the person who is liable for the tax is the trustee. So it says the trustee is liable to pay tax under Section 98 where the beneficiary is under a legal disability. The trustee is taxed in the capacity as trustee and must retain sufficient funds to pay the tax. Now, the trustee doesn't pay the tax personally. It comes out of the trust income. So basically, if the trustee is going to distribute income to one of the minor beneficiaries, the trustee has to retain sufficient income, sufficient money to pay the tax. So the distribution might be 10,000. You work out what the tax is, and the trustee will distribute the rest to the child and keep sufficient to pay the tax. But it's the full amount on which the child is assessed. But the beneficiary pays the tax on behalf of the child. Now, you'll see this a lot in, particularly say in a deceased estate where there are children under 18. The trustee gets separate assessments for each child because the trustee is assessed on behalf of the child. So you don't add it all together and tax it. What happens is the trustee will pay this amount of tax for this child, this amount of tax for that child, this amount of tax for that child. So, for example, if each child's share was 6,000, there would be no tax to pay. Say there were 4 children. You don't add it all together and say, oh, the trustee is going to pay tax on 24,000. The trustee is assessed separately for each child. Let's look at this example. We have 2 beneficiaries, Amanda and Brett, both under 18. Amanda is entitled to 75%, Brett to 25%. The net income is 10. Now, I chose these percentages very carefully because you'll see that the trustee is not taxed on the 10. On the 75%, Amanda will be taxable. Of course, you've got low income rebate, but there's no tax at all on the 25. So the trustee will actually receive 2 assessments. One assessment will say the trustee of the whatever deceased estate for the account of Amanda, taxable income 7,500, tax payable X. Okay, because there'll be low income rebate. Then the trustee gets a second assessment for the trustee of the deceased estate for the account of Brett, taxable income 2,500, tax payable nil. Again, here I've ignored low income rebate. But so the tax for Amanda would be 225, but of course with low income rebate there would be no tax. Now, that's fine, and that would be the end of it. So again, look at our flow chart, and we're saying beneficiary presently entitled under a legal disability, the trustee will be assessed. Then we need to look at what would happen if that beneficiary had other income. Because if the beneficiary's got other income, the beneficiary must then, under Section 100, lodge his or her own tax return, show the income from all sources, so it might be this deceased estate, a family trust, a salary, some interest income, whatever, taxes paid. Now obviously if the children are under 18, it will be the parents who would arrange to have the tax returns lodged. And then they get a credit for any tax paid by the trustee. So if we continue to look at the Amanda example, now here I've kept all the income such that there's no division 6AA. We put all the income together. The taxable income is $16,300. We have the tax payable of $1,545, and there's a credit paid by the for the tax paid by the deceased, the trustee of the deceased estate, and the two deceased estates, I should say. Again, I've ignored low income rebate at this point. So we go through: is the beneficiary presently entitled? Is the beneficiary under a legal disability? Yes. Then the trustee is assessed. We look at the rate, and you just keep following through each of those steps. Now, if, of course, Division 6AA applied, then the trustee might be taxed at 45%. Then we'd come down to the next step. That income is still taxed at 45%. But you'd get a credit for the tax paid by the trustee. The reason for this is that it adds all the income in together, taxes paid at either 45%, or a beneficiary might jump from under 6,000 to over 6,000 once you add all the income in. So even if it's taxed at normal rates, it might be now taxable at 15%. And of course, it will affect the low income rebate. We've finished looking at income to which the beneficiaries are presently entitled, and now we come to the income to which no beneficiary is presently entitled. This is a body of income which can't be attributable to any one person. It's initially assessed under Section 99A unless Section 99 applies. And basically 99A applies to inter vivos trusts and 99 to deceased estates. It's really just a case of working out, is it an inter vivos or a deceased estate, and then following down the flowchart. The main difference is, if it's 99A and an inter vivos trust, it's taxed at 45%. If it's a deceased estate, it's taxed under 99, and the rate of tax depends on the age of the estate. If it's less than 3 years, it's just normal tax rates. If it's more than that, you basically sort of lose the threshold. These rates are in the back of your unit guide, and you'll see one says less than 3 years, and it'll just be the normal rates, and then there's a slightly different one under it. Now, in regard to this area, students really make a mess of it. If we look at a particular beneficiary, and we might say that the beneficiary is entitled to 25%, which is to be accumulated until they reach 18. In the event they reach 18, they don't reach 18, it's payable to a charity or the other beneficiaries or something, in which case the beneficiary is not presently entitled. You don't assess it at that stage. You leave it until the very end. And then the best thing to do is to keep like a little running total on the side. Start with your net income and say beneficiary 1 might be presently entitled to 10,000, beneficiary 2 to 40,000, beneficiary 3 nil. Add up what people are presently entitled to, take them off your net income, and that lump sum figure that's left is the one figure to which no beneficiary is presently entitled. And there will only be one assessment issued to the trustee. So don't try and do it in stages. So in some questions it might say the beneficiary is entitled to 25,000 school fees or whatever can be paid. Any remaining amount is accumulated until the beneficiary turns 18. And what students do is they take out the school fees and then of the rest they tax it to the trustee. But you can't do that. You can only tax the trustee under Section 98 on the income which is actually applied for the beneficiary, and whatever's left will just go into the sort of the pot at the end. So it's a really good idea to keep that running total going on the side as you distribute income to a beneficiary who is presently entitled. You take it off and whatever's left is taxed under 99 or 99A. The last thing we need to look at is Section 101, the income of a deceased received after death. And this would be where someone, while they're alive, they earn some income, and that income isn't paid until after they die. Now, obviously, it can't be paid to the taxpayer, so it is paid to the trustee, and it is income to which no beneficiary is presently entitled. So again, it will form part of that lump sum to which no beneficiary is presently entitled. Once again, have a look at my setting out to see how I do this. I take this amount and from the very beginning exclude it, then look at the rest of the income to which beneficiaries may be presently entitled, take off their bits. If there's any left, I add it to this amount, and that's the amount on which the trustee will pay tax. So we've now got an example here to sort of finish up the whole thing, where X dies during the current year. His estate is as follows. The widow gets half the income. There's a son and 2 daughters who get income at the trustee's discretion. The net income is $50,000. The trustee applies $5,000 to pay each child's school fees, and $500 is paid to the dentist for the son. All the children are under 18. You start with the widow. Is she presently entitled? Yes. The will says that she gets half the income, so she is presently entitled. Is she under a legal disability? No. Then she is assessed under Section 97 at ordinary rates. Now, we don't know what other income she has. Perhaps if she had a job or interest or whatever, we would add the trust distribution to that other income and she would just pay tax on it at ordinary rates. Then we come to the children's income, and the son had $5,500 and each of the daughters had $5,000. Once again, we follow our flowchart. Is the son presently entitled? Yes, under Section 101 to $5,500. Is he under a legal disability? Yes, you're told he's under 18. The trustee is assessed under Section 98 at ordinary rates because this is a deceased estate. The trustee is assessed at ordinary rates on the $5,500. That's under $6,000, so there's no tax to pay. If the son had any other income, maybe the son had a job or whatever, you would then lodge a tax return showing income from all sources. Now we come to the daughters. We would do this separately, but because their figures are exactly the same, I'm just going to do it once. She is presently entitled under Section 101. She is under a legal disability. The trustee is assessed at ordinary rates under Section 98 because it's a deceased estate. Because the income's $5,000, it's not taxable. Then if either daughter had other income, the daughter would lodge a tax return showing income from all sources, and including the trust distribution. Now that still leaves us with some income, and that income is going to be assessed to the trustee under Section 99 at ordinary rates because it's a deceased estate, and so the tax is just the normal tax on $9,500, which is $525. In relation to capital gains in trusts, when you work out the the net income of the trust, if you have a capital gain, you apply the losses, you apply discounts, and then it may be that that capital gain is distributed to a particular beneficiary. If you recall, Section 102-5 says that you apply losses, then the discounts. Because the beneficiary has probably got losses, which is why you've distributed to that beneficiary, you have to first reverse the discount. So if it was a general discount, so if it was 100,000, 50,000 was the discount, 50,000 was assessable, you would then multiply it by 2 to get back to your 100. The beneficiary would then offset his or her personal loss, then you would apply the discount. If the asset is an active asset, you would multiply by 4, because if it was a $100 gain, general discount 50, active asset discount takes you down to 25. So you have to get from the 25 back to the 100, so you multiply by 4, then you apply the personal loss, then you apply the general discount, the active asset discount. Remember that capital gains include the sale of assets and also lease premiums, but of course we don't discount lease premiums. So the trust makes the gain, distributes it, the beneficiary reverses the discounts, then offsets the loss, then applies the discount again. We have an example here of a trust with 2 capital gains, one with an active asset discount and one just with the general discount. It all passes through to one beneficiary. So we reverse one by multiplying by 2, the second one by 4, and then we apply the loss. Now, of course, you'd want to apply the loss to the general discount first, the general discount asset first, then to the active asset, because that's the one that picks up the most discounts for you. So you'd offset 20,000. You've still got 30,000 loss left. Offset that against your active asset. Then apply, so that gives you 90,000. Then you apply general discount, takes you to 45, and then multiply by active asset discount. So a common mistake that students make in this case would be to take the $50,000 loss and offset it straight away against the 40,000 net gain, and so we've still got 10,000 loss to carry forward. But remember, reverse the discounts, then apply the loss, then reapply the discounts. And of course, the last thing just to remember is, because of course you can maintain the character of the income that passes through the trust. If it's a franked dividend, then the beneficiary will get the specified percentage of the franking credits as well. So that takes us to the end of trusts, and what we've learned is the net income of the trust, and then how each beneficiary in turn is assessed. And in the case of Section 98, it's the trustee assessed on behalf of the beneficiary, and under Section 99, it's just the trustee assessed on the income to which no beneficiary is presently entitled. Under Section 98, the trustee is entitled to low income tax offset because the trustee is paying tax on behalf of the child, but under Section 99 or 99A, because it's the taxing of the income to which no one is presently entitled, there is no low income tax offset available.